Well, hey, everybody, we're going to start in 1 minute. So it's good to see you here. Um, Brad Sumrock Live. I'm in Miami Beach. And I know that you can't see each other's chats, but I can see your chats. So I'd love to see where you're all coming in from today. So if you could go ahead and put in the chat, then we'll get started. But I'd just love to see. Let's go. Where are you coming in from today? DFW, Corey from DFW. I see Jacob from Lawton. That must be Oklahoma. Anyone else? I see Dan Breezy, Washington State. What's up, Dan? Nice to have you. Robert Johnson from Bossier City, Louisiana. All right. Mark Lick, Indiana. Rhodey from Vancouver. Candace from Frisco, Texas. Hey, I see somebody else here from Miami Beach. Krom Dimitrov. Did I say that right? Tiffany from California. All right. Well, hey, that's great. So we're going to get started, and I'm really, really excited about what we're going to talk about tonight. And hi, Marilyn from Toronto, and hi, Steve Pasquini and Brandon Jenkins from Washington, D.C. I see you there. So hey, I'm really excited about what I'm going to talk about tonight. And, you know, I recently presented something very similar to this. And lately, I just want to share with you one of the things I've been doing is I've been spending a lot of time attending different events and speaking at events with high net worth investors and family offices. And so, you know, a lot of those folks, to be quite honestly, they're not really looking to get started investing in apartments like as an active investor, but a lot of them have capital to deploy. And so I've been making a focused effort over the last 6 to 12 months, going to family office clubs, going to different events. And I was recently asked to speak in Puerto Rico just 2 weeks ago. And it was a high net worth and family office event with a lot of registered investment advisors and employees that manage basically the family's wealth, and they're looking for things to invest in. So I decided to speak about market cycles and really educate high net worth people and family offices about what's been going on in multifamily for the last 20 years and where I see things right now. So I decided, look, I want to do this similar presentation to you, people that have been following me, and some of you are in my mentoring and mastermind program, and some of you have been to my live events before, or maybe bought one of my home study courses, or maybe even just had some free content and participated in some other free trainings and Zoom masterclasses like this. So this is only going to be an hour. I'm going to be finished at the top of the hour. So whatever time zone you're in, we'll be done in 53 minutes from now or before. And so I'm going to go ahead and share my slides here, and then we'll go ahead and get started. So Sumrock support, I need to be able to share my slides. And I just sent a request. Okay, looks like that's been enabled. So I'm going to go ahead. So over the next 50 minutes, I'm going to cover really 7 things, okay? And for those of you that never heard me speak before or never met me before, I'm going to spend the first 5 minutes talking about how I started and scaled. And then I'm really going to get into market cycles. And I've been doing this now for 24 years, approaching 25 years. And I've been through up markets and I've been through down markets. And I want to share with you, like, when I went all in and when I went aggressive. And I want to talk about when I waited and when I paused. And I want to share with you that most of the time I timed it right. And I also want to share with you there were a few times where I got it wrong, okay? And so because of that experience and success and lessons learned, I think I'm uniquely qualified, having been doing this for almost 25 years, to share with you, where I think we are right now. And again, I may not be 100% accurate in that, but I think I am. And then I'm going to share with you what I'm buying and why. So I'm actually buying an asset right now, and I want to, from an educational standpoint, walk you through what I'm actually buying. Okay. And I'm going to show you like what you need to be looking at right now to de-risk your investment. And then, of course, it wouldn't be a complete training if I didn't give you some specific steps on what you could be doing to win right now. Okay, so this is all going to happen in the next 50 minutes. So my background is not real estate. In my first part of my career, I started in a traditional career. Neither of my parents finished college. I got an engineering degree and an MBA, and I tried climbing the corporate ladder. And I had some successes and I had some failures. And I once even had a boss tell me that I would never amount to anything. And I said, why not? And he said, well, Brad, you don't come in early, you don't stay late, you take your lunch hour, and you take all your paid vacation. And that really hit me because I thought, I don't want to be like you. I don't want to come in super early, stay super late, work through lunch, and work through all my vacation. Like, what's the point of life? And so I struggled in corporate America for 14 years. I was fired once. I was laid off once. I changed companies 5 different times trying to climb the corporate ladder. And then I read Rich Dad, Poor Dad in the year 2001. And that book changed my life. Well, actually, the action I took, and I want to be clear with this, the book can't change your life. It could change the way you think. But if you don't take action, it doesn't make any changes. So the book changed the way I think. And then I sought out education. I sought out mentorship. I sought out joining communities. I wanted to be around other people that were doing it. And so long story short is I went to a real estate investing seminar in 2001. I paid $500. I bought the mentorship program at the end of the seminar. And 8 months later, I bought this beautiful 32-unit building that you can see on the slide. Okay. And this thing put $4,000 a month like clockwork in my pocket every single month. And then 8 months later, I bought that beautiful 30-unit building. This was all going down in Pasadena, Texas, a suburb of Houston. Is anyone here from Houston? If you're from Houston, go ahead and type in in the chat if you're from Houston. Usually there's somebody from Houston. Yeah, I see a couple of you are from Houston, Texas. So Pasadena, Texas. And so I was making $7,000 to $8,000 a month from 62 units. And that was enough for me to quit my job because my job was $10,000 a month, but then I'm paying tax. So my net income was around $7,000 a month. And from 62 units, I have more than that. So I remember reading the Rich Dad, Poor Dad, and even playing the cash flow game that Kiyosaki helped design. And that game basically says that when your investment income meets or exceeds your job income, you can walk away from your job and be retired. So essentially, I was retired at 62 units. And since then, I've done over 11,000 units in 24 years. It's crazy. I know I've done 11,000 units, mostly as a syndicator. And I'll talk about that later, what it means to be a syndicator if you don't know. Okay. But that's my story. And it's a crazy story. And I've had lots and lots of wins, and I've had some challenges and setbacks. In 2013, I launched my second business. My first business has been and always will be investing and owning apartment buildings. My second business is helping other people own apartment buildings. And so I became a coach, a speaker, a mentor, started doing events, and I have free events like tonight, and I have paid programs that go as high as $30,000 a year for my mentoring and mastermind communities. And I've literally helped like hundreds and hundreds of people buy apartments, quit their jobs, reduce their taxes, retire their spouses, pay for their dream home, their kids' education. And it's been amazing. It's been an amazing ride. So I couldn't be more blessed and be more fulfilled on what I've been doing. And a lot of people ask me, Brad, why do you teach and help other people? Like, if you're so good, why don't you just keep buying buildings? And I'll give you the answer is buying buildings puts money in my bank. It reduces my taxes. But when I can do events like this or in-person events or mentor somebody, and then I see them taking action, I see them buying deals, I see it changing their life, that does something to my soul. So mentoring puts deposits in my soul, and doing buildings, well, that puts deposits in my bank account. So that's a little bit about me. 24 and a half years of me figuring it out. And I'm going to share with you this. I know a lot, but I don't know everything. Okay. And anybody that says they know everything or they could teach you everything is lying, because nobody knows everything. I'm still learning. I'm still seeing things I haven't seen, but I know a lot, and I've done a lot, and I've seen a lot, and I've solved a lot of problems in this business. Not only with my deals, but with the over $10 billion of assets that my students have purchased, like over 850 apartment buildings that my students have purchased. So I've been through a lot and I've seen a lot. So one of my mentors, and I believe in mentorship. Okay. I'm not just a mentor. I have mentors. And Tony Robbins to me is like one of the ultimate mentors. Like, if you want to work with Tony one-on-one, it's over $1 million a year. And you get like 6 sessions every other month for $1 million. That's his rate. Tony has coached CEOs, multimillionaires, family offices. He's hired to go into the locker rooms of championship football, baseball, and basketball teams, the pregame, the halftime, and he really works on their mind. He coached Andre Agassi when he kind of got washed up, and then he came back and won Wimbledon. He's coached presidents of the United States when they've gone through different crises. So Tony taught me 3 things. Okay. Well, he taught me more than 3 things, but in regards to cycles, there's 3 things that I want you to walk away from. Number 1 is you got to be able to look in the past and recognize patterns. Okay. So when you see things, how many of you have heard like history repeats itself? Well, it does. So when you see every 10 to 15 years, like in financial assets, Ray Dalio, who's a billionaire hedge fund manager, taught me at a Tony Robbins event because he was teaching. And he said, every 10 to 15 years, every asset class, no matter what it is going to go through some type of correction or downturn. So as you'll see, when I get into the real estate, apartment real estate cycles, we've been through a few of those since 2002. And so you got to be able to identify them. Okay. And when you know that things cycle, what happens is your fear goes away, because you just say, oh, this is a cycle. Sometimes you could say, oh shit, this is a cycle, but it's a cycle. It's predictable. The challenge is you can't always predict when it's going to happen. If everybody could predict when it's going to happen, nobody would ever lose money. And you would never hear about like 2008 when you hear about people losing everything and all that kind of stuff. Like, the thing is, you can't always predict them, but there's going to happen. Okay. There's going to be cycles. And so one of the ways when I go through these next steps here is that knowing their cycles and studying what happened in the past, what that does is it able to use patterns. Okay. And most people just stop at number 1. They see the patterns and they read the headlines. Okay. But most people are not on tonight. This invitation, went out to thousands of people, and there's a lot less than thousands of people on tonight. So a lot of people just read the headlines. And now it's even worse because they're not getting their news from the Wall Street Journal or the Financial Times. They're getting it from Instagram, or Twitter or X or whatever you want to call it. And so you got to go to the next level. You got to be able to use the patterns to achieve your results. And so in multifamily or any other asset class, the minimum you got to be doing, ladies and gentlemen, is understanding the patterns and then using them right now to do different things. You know, do you buy? Do you hold? Do you wait? Do you strike? Okay. And so it's important that you use the patterns. But the people that win the most, okay, the people that make millions, and I'll say millions, and look, I'm not bragging, but I'm one of those people. Over 24 years, I have made tens of millions in apartments. And I've had some deals go sideways too. I've done 67 transactions and 2 or 3 went sideways, you know, but most of them have done really well. And some of them did as planned and some of them went really well. Okay. And it's because I understand to recognize patterns and then use the patterns. And then going forward, like where we are now, we want to recognize where we are now, but now we want to structure things differently because we have some lessons learned from what happened from 2023 until the beginning part of this year. And you could partially argue that some of these things are still happening. And so we got to structure the deals differently. And we got to control the risk differently. And when you do that, you achieve dominance. And what I've done in the past and what many of my students have done is we've dominated markets and have had amazing, outstanding financial results. So let's get into the cycles, okay? I started in 2002 with my 32-unit building. And between 2002 and 2007, cap rates were relatively high. And I'll show you a chart, but like multifamily was not that much in demand back then, okay? And so cap rates for multifamily properties were like 7-8%. You know, the debt was what I would call normal. My first loan was 6% interest rate. Interest rates right now are around 6%. So the cost of debt right now isn't really high. It might be high compared to a few years ago, but it's kind of normal. And there wasn't a lot of competition. There wasn't a lot of people buying multifamily deals in 2002 to 2007. There was a buyer's market for sure, okay? And then what happened in 2008 through 11 is like a lot of the business stopped and I stopped. And part of the reason I stopped is, you know, part of me was like, well, should I stop? And the other part of me was, it just didn't make sense. Like lenders weren't lending money. Like I was mentoring people for an organization before I started my own. And people couldn't get loans. So we would put together these little syndications and buy things, distressed deals for all cash because people couldn't get loans. Okay, it was that bad. So the debt was very, very challenging to get. The equity was kind of skittish, sitting on the sidelines because it's 2008, 9, 10, and 11. And everybody's reading about how the whole world's coming to an end. And it just didn't make sense. So for those 3 years, I really didn't buy anything. Okay. And then I started buying again, like right at the end of 2011, 2012. I bought Kirkwood Park in Irving, Texas, and I bought Pioneer Creek Townhomes in Arlington, Texas in 2012. And that deal I bought in 2012, I ended up winning the National Apartment Association Investor of the Year for this deal I bought in 2012. And a lot of people said I was crazy buying in 2012, but because I saw the patterns, I recognized the patterns and I used the patterns and I structured the deal and the debt correctly to fit where we were in the cycle, like that Pioneer Creek Townhomes deal that I bought in 2012 absolutely crushed it. You know, we bought it for $13,000 a door back then and sold it for $42,000 a door. It was 213 units. So look, I got in and I stayed in. And so for a decade, like I literally went from like 500 units, like to 11,000. And obviously this is part of the time I got wrong. You know, I stayed in a little too long. And what happened was, in hindsight, the market peaked in 2021 and 2022. Okay. The debt markets changed. Like the Fed raised rates 16 times in 12 months. Not only that, taxes went up, insurance went up, supply went up, all after the pandemic. And then I stopped. Okay. But I was very aggressive for a decade. And I stopped and I said, okay, well, let me see what happens here. So 2023, 2024, I didn't buy much. In 2023 and 2024, this was the time of like all these properties that were bought in 21 and 22. Many of them you have had capital calls, loan defaults, loan extensions, loan modifications. And so we had to adjust our strategy. And then I started seeing light at the end of the tunnel. The first sight of the line at the end of the tunnel was the big, beautiful bill was passed, 2025. They gave us 100% bonus depreciation. And now in 2026, I'm buying aggressively again. So I just closed a deal in February, and I bought a deal in Irving, Texas, and I'm buying 229 units right now that I'll talk about before the end of the night, because I want to show you what it is I'm buying and why and how we're structuring it. So this is kind of a busy chart. And I'll be honest, I didn't create this all on my own. I used AI and GPT, and it's not perfect, okay? But I got it as close enough. So you can see the first side on the left, this was the aggressive buying time for me. You know, I started, cap rates were over 8%. You could see how they went down to 6.9, 6.8%. I bought aggressively during this period. 2008, 9, and 10, look what happened. Cap rates skyrocketed up. I didn't buy anything. It was hard to get loans. It was hard to close deals. It was hard to raise money. There was a lot of confusion and uncertainty in that period of time. In 2012, I started buying aggressively again. You could see cap rates just slowly went down from 6.6% all the way down to 5%. And so many people waited and didn't get in. Like some people waited until 2015 to get back in. And they waited a long time and they missed the best buying opportunity in a decade. And then there were some people that didn't get in at all until 2021, 2022. And you can see that's the red zone over here where it says peak compression, 2021, 2022. This was after the pandemic. Right after the pandemic, rents were going up 40% without doing any value add. Interest rates were 3%, but values were skyrocketing and a lot of people kept aggressively buying. And then boom, what happened? What happened at the end of 22? The Fed raised interest rates 16 times, insurance skyrocketed, taxes skyrocketed, new supply that was, on hold during the pandemic in many Sunbelt markets. All this new supply came on in Austin, Vegas, Phoenix, Dallas, Houston, Nashville, Atlanta, Charlotte, all the best markets for the last decade. All of a sudden they're flooded with oversupply and there were massive distress. So then in 2020, at the end of 23 to 24, I was like, okay, I got to take a pause here from my buying. Even I was trying, I made offers, but we didn't get deals because we were only willing to pay this much and the seller still wanted this much. Everybody thought interest rates were going to come down faster. Everybody thought, prices were going to go back up. So now what's happened is interest rates haven't come down faster. Prices haven't come back up. So all these sellers that needed to sell in 2023, 2024, 2025, they got these 3-year variable rate loans when they bought their properties in 2021, 2022. The debt expired in 2024, 2025. Some of these lenders extended them for an extra year, an extra 2 years. But now they're not extending them anymore. Some of these people are 4 or 5 years into a 3-year loan. And the lenders are saying, sorry, we can't keep extending the loan. Interest rates haven't come down. You're underwater. So now what we're seeing a buyer's market. We're seeing distressed deals and we're seeing amazing pricing. So I don't know how else to explain this. Hopefully that chart did a pretty good job. So I want to show it to you this way. This was the plan that a lot of operators had in 2021 and 2022. And this is just an example. So it's okay, let's go in and buy this deal for $23.5 million. We're going to get a 3-year interest only loan. We're going to refinance it. we'll have our loan is 18 million. We need 8 million of equity. So that gets us to the purchase price plus some CapEx, some renovation. And we will renovate and add value, and we'll drive up the value to 29.4 million. Then we'll refinance in 3 years at 22 million into a fixed rate loan. We'll return half of the equity, and then we'll have a cash flowing asset for the next 10 years. So this was the plan, okay? What actually happened is, again, interest rates went up in 2023, 16 times. Expenses went up. Inflation was way higher than 9%, okay? New supply in just about every Sunbelt market in the country skyrocketed. So all of a sudden you have all this new supply of multifamily housing. So vacancy is going up, concessions are going up, so rents are going down, insurance is going up in a lot of Texas and Florida markets because of storms, and cap rates went way up. So that deal that people bought at 23.5 million to get it to 29, if the NOI stayed the same, by the way, if you're an operator and your NOI stayed the same from 2022 to 2025, arguably you did a good job, because expenses are so much, like NOI is income minus expenses. And so if your expenses went up, your taxes went up, your insurance went up, and your rents went down, and somehow your NOI is still the same, like you actually did a pretty good job. But the cap rates went from 4% in 2021 to 6%. You can see the chart. Cap rates when we bought the deal were 4.25%. Now they're 6.25%. So instead of the property going from 23 to 29 million, it went from 23 to 16 million. So this is what happened. And you can see that from 2021 to now. Okay, so that's what happened. So where are we at right now? Okay, right now, looking at everything I shared with you from Tony Robbins, pattern recognition, pattern utilization, and pattern creation, real estate's on sale. We're at or near the bottom of a cycle. Okay, multifamily starts, the new projects are at a 10-year low. So there's very few, in many markets, very few new development projects happening. So all that new supply has come to a standstill. The demand for multifamily housing is very high because buying homes for working and middle-class families is becoming less and less affordable. And right now, we still have a lot of buyers sitting on the sidelines waiting. Okay, they're waiting. I used to have 800 people on these webinars that I do. I don't right now. And so there's not a lot of buyer competition. But what there is a lot of is there's a lot of deals that were bought in 2021 and 2022 that are over leveraged. They're distressed, but the property's not distressed. The capital is distressed. The GPs are distressed. They're exhausted, they're tired, and their lenders are giving up on these loans. And so there's a reset in value. And so their loss is going to be our gain for those of us to get in. Okay. And then the big, beautiful bill, well, that gives us 100% bonus depreciation. So if you want to get a great deal and possibly reduce your tax, now is the time to strike. Okay. And so this is the big, beautiful bill. We could see the depreciation was scheduled to be phased out. And now it's back to 100% starting in 2025. And here's another chart showing you how working class families are just priced out of buying starter homes. So the PITI, principal, interest, tax, and insurance, for a home payment is about $3,100 a month for a median priced home. And it's $1,800 a month for a median priced apartment. And only 27% of families can even get a mortgage on a median priced home. So where are they going to live? They're going to live in our apartments. So you got to get into the business, ladies and gentlemen. And there has been one property class that has emerged as a clear winner, and it's the B class. See, the class A, even right now, class A is still suffering from all the new supply coming on. I own a 2016 property in Dallas, and right in uptown Dallas. And right across the street, we have new inventory coming on. It's a lease up. So they got to get from 0% occupancy to 90% occupancy. So they offer move-in specials to get people in the door. And people from my building are moving across the street because it's brand new. It's 10 years newer and the price isn't much higher. So the A's are still impacted. The C's are impacted by affordability. The C's are people making, $50,000 a year as a family, and they get hit hard by the, when there's inflation. We hear about affordability in our country. Well, the B class are people that generally make between 50 to 80,000 a year. They're very stable tenants. They pay their rents on time, but they still have a very limited path to home ownership. Okay, and that's key. And so the B's right now, the way we're making our money, we focus on execution, we focus on operations, we focus on fundamentals, we focus on renewals. Okay, we focus on expense management. I mean, yeah, there is a value add component, but the days are gone of us coming in and spending, big money and doing fancy upgrades on units and trying to get 20% rent increases. There's got to be another way. And so what I found through this pattern creation process is right now I'm buying B class properties, and our strategy is what's on this slide right here. Focus on renewals, reducing turnover, strategic CapEx where it makes sense, but not across the board value add, and tightly running the property and tightly running expenses. So when I showed you before, this deal that was bought in 2021 for $23 million, and people thought it was going to be worth 29, well, it went down to 16 million. And so now, as an example, we could buy that deal for 16 million today. It's somebody else's problem. Somebody paid 23, their loan value is 16. We could buy it for at or near the loan value. And then one of the things I've talked to high net worth and family offices about is like, what type of returns do you like to see? And let me share with you something. Family offices, they don't want to see 20, 30% IRRs. They think it's too good to be true. And I will tell you it is. When I see IRRs over 20%, I'm like, that's bullshit. That's not conservative underwriting. Like, multifamily buildings don't produce, and I've been doing this 25 years now. Please listen to what I'm saying. Multifamily buildings, they have produced in the past over 20% IRR, but there's never been a projection that I've done that shows an IRR of 20%. Now, sometimes the market got hot and we outperformed 20% for sure. But if you see underwriting that shows like an IRR of over 20%, like, it's way too aggressive. Okay. And that's what that's what rich people know. Rich people are like, that's way too aggressive. Like, you don't know what you're doing. Okay. So right now people want capital preservation, and they want a solid asset, and they want fixed rate debt, and they don't want to see cap rates going down in your underwriting. And they want to see very conservative growth, okay, with a 6 to 8% cash flow and a 15% IRR. So what does this mean for you? Okay, so how do you get started? Well, there's 3 ways you get started, okay? And you could start buying your own deals with your own money like I did. I bought 32 units in 30 until I ran out of money, and then I became a GP in a syndication. So you could start with your own deal. And 2 weeks ago, I did a class on buying your own small apartment building with your own money, and some of you were on it. The other way you could start is a GP, where you're the active investor doing the work and putting the syndications together. And the third way you could start is a passive investor, okay? So I want to give you some actionable strategies on how you should start, depending on which one of these 3 ways you're going to start. So if you're going to buy your own deal with your own money, like I started, or if you're going to be a GP or a co-GP, which means you're going to be the active investor and raise money and find, analyze, and manage deals, I'm telling you the best way you could start or scale is you got to invest here in the 6 inches between your ears before you invest in buildings. Okay. My 32 unit, I put 200,000 down. I didn't want to lose that money. So I invested in my education. I went to seminars. I ultimately found a mentor and paid him. And I joined the community of like-minded people, other people that were investing in the same asset that I wanted to invest in. So again, if you want to be a GP, an active investor, and syndicate deals and raise money and find deals, analyze deals and manage deals, you gotta start this way. And I've been a mentor to many, many people. So I would be honored to be your mentor, okay, as you start the journey. And if you're going to buy your own deals with your own money, like I did, I started the same way, okay? And so for those of you that want to be active investors, you got to learn a system. And I teach a system. I teach how to understand the deal and the business model. I teach how to find deals, how to fund deals, and how to close and manage and exit the deals. And I'm teaching this coming up at the end of June. We start Friday evening with a short session, and then we go all day Saturday, the 27th, and until 4 p.m. on the 28th, Sunday. So again, it starts at 5 p.m. The 26th. So you'd arrive into Dallas by, say, 2 p.m. and get situated in the hotel. And then we start at 5 and we go from 5 to 8 on June 26th, which is Friday, all day Saturday of learning. And then Sunday from 9 to 4. And then just 2.5 days, I'm going to teach you how to find deals, how to analyze deals, how to fund deals, including raising the money and getting the debt, and how to close and manage and exit the deal. And here's the deal for you guys. This is a free event. Okay, I used to charge hundreds of dollars for this event, but now I'm letting you come for free. And why is it? Honestly, is we need more people. There's a lot of deals out there and too many people are on the sidelines. And I'm an ambassador of the business. I see the patterns. I recognize the patterns, and I want to teach you how to use the patterns to make money and change your financial future. Okay, so all you have to do, and you register for free, no strings attached, is you just scan that code. So let's go, ladies and gentlemen. We're not here to just learn. We're here to learn and take action. One of my students that's in my mastermind community is on tonight, and he came to this event, I don't know, in 2016 or 2017. Dan, are you on? Could you talk about when you came to this event and how it helped you? Let's see if we could get Dan Breezy on here. There he is.
Yeah, can you hear me okay, Brad?
Yeah. Hey, Dan, how are you?
Hey, great to see you. Great to be here. Thank you so much for having me. Yeah, I came in 2017. I was in a snowboarding career and I was looking to transition to be a full-time real estate investor. I had about 30 or 40 units at that time. And so, yeah, I was traveling all over the country looking for a mentor to really help us learn the business.
Yeah. And so, so before you came to the event, how many doors did you have, like rental units? Like we say doors for those of you that are new. So one door could be a single family, like 10 doors could be, a small multi-unit, or, 5 single families and a fiveplex is 10 doors. So Dan, how many doors did you have when you came to Rat Race in 2017?
Yeah, when I came there, I think we had right around 55, maybe 60 units. I started with
So
50.
you already had a lot of success. You already had 55 or 60 units.
Yeah, I would think that's probably more where I was at. I had a duplex, a nineplex, a 24 unit, and then we bought a 28 unit deal. So somewhere in there.
And you still saw it, you still were seeking education and mentorship to go beyond that.
Yeah, I didn't know what I didn't know. And when I was at Rat Race to Retirement, a lot of the terms you were speaking about, I really didn't understand. And so, our style of buying before getting trained was a little bit more mom and pop style, fixing out a cash flow, not buying with the safer debt, not raising capital. So very inefficient. And so, when I heard these terms and when I sat there, it was really a moment of like, okay, these are my people. This is what I've been looking for.
Yeah, and Dan, just tell me, right, and share all with all of us, how many properties have you had, in total since, in your career since 2017? Like how many doors and how many properties?
Yeah, so we have just over 3,000 units. We're managing about 450 million of assets, and we're managing 195 million of equity. So it's been a phenomenal investment, and really, grateful for the program and to be a part of the group for so dang long.
Yeah. Hey, Dan, thank you. So look, I'm doing the event for free. So like, and here's what I want to tell everybody. I know your time isn't free. And I know for many of you, you have to get yourself to Dallas and you got to get a hotel or stay with a friend or whatever. But like, that's the other reason I'm doing it free. Okay. Because even though you don't pay the Sunrock Company to come to the event, it's still, and I know how hard it is to get away for some of you that have families and commitments and all that kind of stuff. So like, I'm sensitive to that. And so scan here, come as my complimentary guest to the event. When you scan, you will see that there's a paid option. Okay, there's a free option, which gives you everything you need to get all the content. And if you want to have an enhanced experience where you have lunch with me, you have better seating, and I'll do a bonus training on how we underwrite deals, then that's only a couple $100, which is less than, a cost of dinner for your family. Dinner for four in most places is hard to get for $200. So I promise you, if you do the platinum upgrade, it's going to be a huge value. So thank you, Dan. And there's one other thing I want to share with everybody. Okay. And Dan, you could stay on here, but I want to also share like where you could start as a passive investor. So what I've done now is I've shared with you market cycles and when I waited and when I strike and where I think we are right now. And how do you want to get started if you're going to be a GP or buy your own deals with your own money? But look, as a passive investor, there's four things you need to do. Okay. You got to get the right deal, meaning the right building. And what I shared with you is B class is the sweet spot. Okay. Number two is you need to buy in a right location. Okay, so if you're investing passively, you got to be like, what's the property classes? What's the demographics? What's the area? Is it growing or dying? What's the demographics? Are people moving there or moving away? You got to be with a strong GP team that's been through ups and downs. Okay, let me tell you something. The only person that's never had a challenge, and it kind of makes me sick because I see them all over the place now on Instagram and LinkedIn. And they're just starting. They have one deal and they never had a challenge. And they're throwing people that have had challenges under the bus, and it's like, just be really careful because like the people that have been through the cycles and they have taken the lessons learned and now they're better de-risking their future investments. Those are the people that I want to invest with. And those are the people that I'm partnering with. And that's why I have Dan on here, because I've known Dan since 2017, and he and I and his partner, Mike, are doing this deal and I want to show you what it is that we're doing. So Dan, I'm going to walk through these, but you could chime in here. So what I'm buying right now with Dan and his partner, Mike, is a deal in Plano, Texas, like one of the top 10 cities in America, okay, in terms of places to live, okay? Income, school districts, healthcare, like all the amenities are in Plano. Okay. And so this is a 229 unit B class property. Okay. And you can see how we structure the deal. It's a 7% preferred return and about a 93% return over 5 years. Okay. So, and I'll be honest with you too, like this is a live deal. And so if people are interested in investing, we'll show you how to do that too, but stay on either way because I'm going to teach you what it is that we're doing and how we're structuring the deal and how we're de-risking it. So when you look at the numbers, this deal we're buying for under 38 million. And that's close to loan value. The guy we're buying it from, and he's a big name guy, so I don't want to mention the name. But if you're in Dallas and you're in the business, you probably heard of the company. but they bought this deal in 2021 or 2022. It was just like the slide that I showed you. They bought it here and it went down in value to here, and they got to exit the deal or they're going to lose it to the bank. And so it's a forced sale. They can't keep kicking the can down the road on their loan. So we're buying it less than like $7 or $8 million less than what they paid for it.
Yeah, almost $8 million below what they paid for back.
$8 million than what they paid for it. And that doesn't include all the CapEx they put into it.
Mm-hmm.
Okay. So our loan is a $28 million loan or $27 million loan, and it's a fixed rate loan. So that's the other thing you got to understand right now. One of the things that created all these challenges were getting these aggressive short-term loans. And so, Dan, are we getting a 7-year loan, a 7-year fixed rate loan?
Yep, that's correct. 7-year fixed rate, non-recourse loan with 4 years of interest only.
Yeah, so 4 years of IO, non-recourse, 7-year fixed rate. So it's the same interest rate, no interest rate caps. You have the same debt payment each and every month for principal and interest for 7 years. So that's one of the things that you, in this cycle right now, this is one of the big things when I talked about pattern recognition, pattern utilization, and pattern creation, is we got to get the right debt with the right class, okay, with the right business model and the right asset, and that's Class B fixed rate debt. So you can see the numbers. Now, the next thing is, what do we love about the deal? And I'm not going to read all this to you, but number one is location, location, location. So those of you that know Plano, and for those of you that don't, again, Plano is like consistently one of the top 10 or 20 cities in the country in terms of livability index and safety and like upper middle class neighborhoods. So when Dan asked me to be part of the deal, I went and drove by, I walked the property, and then I went to lunch, and I literally, Dan, you remember, I walked from the property to the Whole Foods right across the street, and there's a Pottery Barn, a Williams Sonoma, I mean, like high-end retail. And I had lunch at the Flower Child, which is like some, it's not all vegan. They have meat there, but when you got vegan and vegetarian restaurants, like, which I'm a carnivore, but like, it's a high-end, like hoity-toity neighborhood, So you got the location. It's an affluent area. Proven rent growth opportunity. The comparable properties are over $200 higher per month in rent, and there's zero, absolutely zero new deliveries coming on within 2 miles over the next 2 years. So we're insulated from new supply. So again, like all the challenges we've had, variable rate debt, we don't have that. New supply, we don't have that. Class C tenants, we don't have that. Growing neighborhood, we have that. Walkability, we have that. And then when you look at our value add, this is very interesting. We're not just upgrading units. We're literally taking 1 bedroom, 1.5 bath townhomes, and we're able to convert, I don't know how many of these, Dan, like a whole bunch of them, into 2-bedroom units because of the way it's like a 1 bedroom with a den, which is not a very easily rentable, high demand unit. And we're going to make it into 2-bedroom units. And so just by doing that, we're going to be able to get $200 a month. And so this is the kind of value add that I'm talking about right now. The day of just throwing a bunch of money at a property and doing upgrades and praying that the rent will go up, that's not happening right now. So Dan, how many units are we able to do that where we literally convert it from a 1-bedroom to a 2-bedroom?
Yeah, we have 62 units like that. So it'll be a great
value add
strategy. Yeah, you put up some French doors. It's one of the strongest value add strategies we've done on other deals, and it's a great way to utilize space here.
Yeah, so it's like 25% of the property is going to be converted from a 1-bedroom to a 2. Like, that's amazing.
Yeah.
So again, we already talked about the price of where we're getting it at. And the other thing that we've learned is that you got to look at the people living there right now, and are they paying the rent? And so right now, with the current condition of the property, the delinquency, which is the people that live there and are not paying the rent, it's less than 2%. And so like we've seen properties where it's like 7, 8, 9%. And that's like, you can't, if the current people aren't paying the rent, now it's riskier because you got to re-tenant the entire property. So here we're not doing that. Okay. And then Plano school districts are like very, very high, nationally recognized. So, Dan, did I miss anything here?
Nope, you nailed it. The Plano School District is huge. It's what attracts a lot of families because they can't afford the home in the submarket, but they can rent from us for 15, 16, 1700 bucks, and it puts leases in for a very long time, 5, 10, 15-year leases, which prevents turnover.
For sure. And the next thing I mentioned, ladies and gentlemen, is you got to pick a right market. Well, you can't, it's hard to pick a better market than DFW. Okay. It's the number one growth market in the country. So like, I don't really have to say much more about that. So like, you got to pick a great, and then so DFW and then Plano within DFW is like top market. Okay. When you look at the demographics within 1 mile of the property, the median household income is $105,000. And all the schools, the elementary school, the middle school, and the high school that are zoned for this property are all A rated. Okay. So we're not talking about like the standard workforce housing here. I mean, we're talking about like higher income people making $50,000 to $80,000. That's a B class tenant. Again, very stable. They pay the rent, but they still have a limited path to home ownership. So again, just the loan details, fixed rate debt, 7-year loan, 4-year interest only. The rate is around 5.1%, which is a phenomenal rate. It's non-recourse. And one of the things I want to also share with you that we're doing to de-risk the deal is we have zero financed rehab. Now, some of you might say, Brad, why? I thought you want to maximize leverage. Well, that actually works in some markets, in some cycles, but it doesn't work right now. And the reason is that when lenders give you the rehab, they also control you like a puppet on what rehab you do. And when you buy the deal, you have to give them a list of rehab. And then if the market changes, you can't change it. And Dan and I both know that because we've been in deals like that where we like maxed out on loan dollars for rehab, and then the markets change and you want to reallocate stuff from one thing to another, and the lender's like, no, like you have to do what you said 3 years ago. And it's like, well, we're not able to raise rents. And they're like, we don't care. And so we have lower leverage than only 72%, which means we need to raise a little bit more money. But that also de-risks us, with lower leverage. And we have 100% control of our spend on our rehab. So we could pivot as the market requires us to, which is huge. That's a huge, huge game changer. So the next thing is we have it structured with a preferred return. So a 7% preferred return means that the GPs do not get any of their waterfall. And you can see we have like an 80-20 split if you invest under 500,000. And if you invest over 500,000, then you get a better split. You get an 85% split. But the GPs don't get any money from operations until all the LPs get a cumulative 7% preferred return. Okay. So that's how we're structuring the deal. And you can see the rest of the fee structure, which is kind of standard for in the industry. And then the last few things are you got to pick a great team. And many of you know, like I've mentored and coached, I want to say thousands, but definitely hundreds and hundreds of people. And I've had a lot of success. And there's very few that I would say that I would partner with or I'm excited to partner with as much as I am with Dan and Mike. And we've done several deals together. We're in some deals right now that are doing well. And Dan and Mike both came into my community like 9 years ago, and I know them personally. I mean, I would vouch for them. Obviously, you need to do your own diligence, of course. But the fact that I'm here with them tonight and doing this deal with them, like I vouch for them. But again, you should go ahead and do your own diligence, of course. And finally, this is their track record. So I talked about like investing with a GP team that have been through some ups and downs, and Dan and Mike have certainly been through some ups and downs, and most of their deals have done or are doing really well, but they've had one or two that went sideways just like I did. And the thing is, we've learned from it. And what we've done is we learn from it, and then we just keep getting better and better. So that's the game, ladies and gentlemen, is you take action, you surround yourself with great people, you have great teams, you have great accountants, you have great management companies, you have great lenders, you have great vendors, and you do your best. And we've done really well. And I know Dan's done really well for his family, and his partner Mike's done really well for his family and their investors. You can see the returns that they've delivered and that they are delivering over time. And so I'm really confident and excited about this deal. So this is what it looks like over a 5-year hold with $100,000 investment. And you can see the returns in year 1, 2, 3, 4, and 5, and then the return of capital and the gain at the sale, which we're estimating a 5-year hold. So that's what the deal looks like. And I promised you would be finished at the top of the hour. And so, look, this is if you click here, which I'm not sure you could actually click on the slide deck, does that actually work, Dan, if you click it? I think it does.
I don't know. That's a great question. Hopefully, Crystal Lee, you would
Well,
know.
we could put it in the chat. So for the attendees, we just dropped the URL in the chat box, and that brings you to the cash flow portal where you can start filling out your paperwork. But I think it works. Like, Dan, try to click on that link. I think it actually brings you to a portal.
It's not working for me to get to the portal, but I do see it in the chat, and that link does work. I'm clicking on it, and it's bringing me to the right spot.
Okay. Well, I guess it doesn't. I guess on mine it works because I actually have the PowerPoint slide on my screen here. But so go ahead again and put that in the look in the chat box. There's a URL for those interested in investing. And here's the other thing I'd say. If you're interested, but you're not quite ready to click here to invest, I want you to type in the chat the word invest so that Dan and I can get with you, set up a call, and answer any questions you have. So let's go ahead again. And if you're interested in investing, type the word, if you're ready to invest, go ahead and click there. And if you want to have a call and ask questions to see if this is right for you, then go ahead and type in the word invest. So just type the word invest into the chat box. And then the other thing I'll just say and finish up is, everybody, this is a no-brainer. Either way, whether you invest in this deal or not, like, you got to be at this event, because I'm going to teach you from acquisitions to asset management and everything in between. I'm going to teach you how to find deals, how to fund deals, how to close deals, and how to manage deals. And it's a free event in person. It's not, you cannot attend this event in Zoom. You cannot attend this event from home. You have to be in Dallas the evening of June 26th, all day June 27th, and all day until 4 o'clock June 28th. And I'm going to teach you how to find, fund, close, and manage and exit deals profitably. So with that, yeah, if you want to invest, again, let me just go back here. Type in the word, you can click here to invest, or you can type the word invest into the chat box, And I see a couple of you doing that. And yeah, there will be another event that I'll do, at least one before the end of the year, to those of you that are asking. But if you can, try to get yourself to this one at the end of June in Dallas, Texas. So again, I see some of you in the chat box saying the link doesn't work, which means that if you're telling me the link doesn't work, then type in the word invest. If you don't type in the word invest, then we won't know that you have an interest, and we won't be able to contact you. All right, everybody. Well, now I'm seeing from some people that the link does work for them. So again, if the link does not work and you're interested to invest, type in the word invest so that me or Dan and our teams know how to get with you. And thank you very much. It's past the top of the hour and we're going to wrap up. So thank you. And I'll be doing another one of these in a couple of weeks. Thank you again. Good night, everybody.